Evolution Gaming is a leading provider of live casino solutions, offering real-time streamed gaming experiences such as blackjack, roulette, poker to online operators all worldwide. Now, when we take a look at this company, it is down around 10% in the pre-market, and it gets a strong buy rating from Seeking Alpha, and when the market does open, it'll be trading at a new 52-week low with a forward yield that will soon be touching around the 4% mark. Now, this is a company with high risk but as well high reward, and we're going to discuss our thoughts in today's episode. But first, we need to start off by why this company is down around 10% just in the pre-market today. Now, the main reason for this is the UK Gambling Commission, the UKGC, did initiate a review into the company's UK operating license. This was prompted by findings that Evolution's games were accessible to UK players through operators that didn't have the UK licenses, and this raised concerns about potential regulatory repercussions. Now, do bear in mind the UK market for this company is only 3% of their total revenue. However, the review as a whole has unsettled investors due to possible outcomes. Now, these range from fines to license suspensions or in fact revocation, but analysts do suggest that the market reaction right now is a bit of an overreaction and that ultimately this could be seen as a massive buying opportunity. Now, it is down around 31% over the last year. Over the last 5 years is up 167%, meaning it's outperformed the S&P, and we can see a bit of a roller coaster over the last 10 years with all-time highs around the $200 mark, and that is really 3 times the price of what the shares will be when the market opens. Now, we also notice the trailing 12-month P ratio is going to be well below 13 now, given the drop. So it does mean this is one that could have a really strong growth potential in your portfolio. We're talking 2 or 3 or in perhaps 4x potential. Now, let's also cover the risks, but first thing to note, they did report their latest earnings on the 24th of October, where they did have a marginal beat to their top line of 1.5 million, and when we take a look at the earnings per share, we did in fact notice a marginal miss. So beat on revenue, miss on earnings per share, but one thing we really like, as we will come to show you, is their underlying metrics. First thing to note, especially for those that love dividends and growth, not only an attractive yield, but their latest full increase was at 33%, and we can in fact see over the last 5 years and over the last 10 years, these are some of the most attractive increases that we have noted on this channel, but we can see over the last few years, the dividend increases have been a little bit inconsistent. In terms of looking at the actual underlying metrics, well, first one is the free cash flow payout. Remember, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. What is nice to see that over the longer term, it has been around that 60% blanket threshold that we want to see. In fact, over the next 12 months at 49%, that is pretty much in line with historical figures, meaning that we should expect the continuation of very attractive increases. And with free cash flows, remember, we do want to note consistent increases over the longer term, and we've actually seen an acceleration of that growth over the period. $5 in the most recent annual accounts. We also notice over the next 12 months, we are anticipating a 10% increase, which is very attractive, and we do anticipate, given the strength of these metrics and the financial outlook, that this growth is going to continue. Now, in terms of sales growth, we get double digit every single year. Some years a lot better than others. You could argue we may be seeing a slowdown of revenue, so something to factor in when we come to our own valuation process, and we can see 19% on a trailing 12 month, so at least that does confirm that 2024 should be an equally strong double digit year. If you want to see it from a numerical standpoint, well, 10 years ago, they reported $50 million on their top line. On a trailing 12 month, we get $2 billion. And we can also highlight here the shares outstanding. Over the longer term, unfortunately, they have diluted your position as a shareholder. But remember the key principle here, if they do continue to outperform the S&P, then that at the something isn't something to be worried about. ROIC 10% or more, give us faith management are able to effectively allocate their capital. Now, we get a lot of inconsistency. Nonetheless, from the COVID lows of 11%, we can see the uptick to around 33% on a trailing 12 month, which is very impressive. We do like to see that. It has recovered from the 11% lows. and we also get to see some very impressive operating efficiencies. Not only the margin above the 16% minimum, but look at that, 28% in 2014, where the revenue was fairly low in comparison, 64% in 2023, where the revenue has only increased. So we get the high quality criteria that we try to identify, top line revenue growth, as well as margin increases. We also notice some very, very impressive free cash flow margins, 61% in 2023, 56% on a trailing 12 month. We also notice the net debt to EBITDA, remember the earnings before interest, tax, depreciation, amortization, 0 right across the board, which tells us it won't even take this company one day to pay off all of their debt net of cash on hand. A very, very strong balance sheet. Now also we have just released our latest free weekly article where we cover 2 beaten down quality stocks that look like massive buys. Now remember, we release one every single Monday morning where we essentially highlight severe undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, as well as grab a copy of 28 undervalued stocks for the month of December, as well as the upside that Wall Street themselves see. And you can also grab a copy of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We can then have a quick look at some of their highlights from their latest quarter. Their top line revenue, now this is in comparison to the same quarter last year, was up around 28%. Their EBITDA was up around 30%. And we also noticed their margin sitting around 68.5%. So it does look good in terms of the growth. We also see similar growth comparatives against the first 9 months of the year against the similar 2023 comparative. We also notice that they do flag here the increase in headcount year on year. Very interesting to see that this is a metric they talk about, because naturally you would believe the increase in staff does then relate to increase in expenses, but likely they are trying to show you that essentially the reason for this growth is due to the fact that they are getting a lot of activity within their gaming systems, and that is pretty much confirmed when we do take a look here at the activity in the network. Year on year growth at 29%, but we can see that trend over the longer term, it is moving in the upwards trajectory. We also can see in terms of the numericals from what we were covering, July to September, their total operating revenue at 519, which is growth from the same period in 2023. And again, their revenue has only been increasing over the period, something that they do really like to highlight and something that is also backed up by the numbers. But we do also need to give consideration to some of the risks. And we've taken a look at their essential annual accounts where they talk about several risk factors and what that means for the company. Now we're just going to cover some of these. The first one being the regulatory risk. As a gambling service provider, they are subject to stringent regulations in multiple jurisdictions. Non-compliance, as seen in the recent UK Gambling Commission review, can lead to fines, license suspensions, and even reputational damage. We then also have the consideration for market concentration. A significant portion of their revenue does depend on a few key markets, and any changes in regulations or market conditions in those regions could disproportionately impact the company. We then have competition. The live casino industry is competitive with rivals such as Playtech, Pragmatic Play constantly innovating, and they must continuously invest in technology and content to maintain their market leadership. And then we have currency and economic risk. Operating globally exposes them to currency fluctuations, economic uncertainties in all of the different regions. You have reputational risk, issues like accessibility of their games through unlicensed operators, or in fact being associated with illegal gambling can harm their brand, and more importantly, investor confidence. And finally, technological dependence. The business relies heavily on seamless technology, internet infrastructure, so disruptions, cyber attacks, or software failures could essentially affect their operations overall and worldwide, and therefore diversification and risk tolerance is essential when considering this company and investing in Evolution Gaming. Now we've already talked about their top line revenue, which has seen some very impressive growth over the longer term. In fact, we can see based on the trailing 12 month, and as mentioned earlier, that we are expecting another double-digit year into December 2024. But we ideally want to just flag here their bottom line net income. What story does it tell? And just look at that, very consistently in line with their top line revenue, which is always a great sign. 15 million reported in 2014, 1.2 billion in 2023, with an expectation of around 1.3 billion in 2024. That is a very strong positive. Then we take a look at the balance sheet, quick health check, total cash versus total debt, and we do notice their cash position has increased over the period, pretty much following around their revenue metrics. 10 million in 2014, 739 million in the latest quarter. Now remember, one number here in pure isolation isn't going to tell us anything, which is why we compare it to their total debt numerically and directionally, and we can see over the longer period, even though it has increased, sitting now at 91 million, their cash is far superior, and as we said, it wouldn't take them one day to pay off all of their debt net of cash on hand. We also very quickly just want to highlight the cash this company generates from operations, and again similarly has increased. On a trailing 12 month, this sits at 1.4 billion. Now we want to look at some gradings. It is a European company, therefore we don't actually have the grading itself, but what we can show you in terms of the P valuation sitting around 14, it is lower than the sector median at 18.5. Therefore, if you are buying this company, you are getting around a 25% discount. Question is it worth a discount? And we will also run this through our valuation process to look at our margin of safety. But again, you can see, depending on which valuation metric used, it is trading at either a premium or a discount. In terms of their growth grade, well look, year-on-year revenue up 19%, sector comparable at 2.2%. Forward looking at 16%, sector comparable at 3.1%. So we can in fact notice their metrics are looking very good, well above the sector median. So actually it shouldn't be trading at a discount if you think about it. It should perhaps be trading at a premium, and therefore the market in essence could have overreacted. In terms of their profitability, well, gross margin 100%, sector at 38%. Bottom line 56%, sector at 4.2%, and we can also see, and as we flagged, their cash from operations 1.44 billion, significantly above the sector median at 276 million. Now, two things before we do jump into our own valuation process, but we can clearly see here against others in a similar industry, casino and gaming, in terms of total return, it is the worst performing, although we do notice MGM also down over the last 12 months. In terms of the last 5 years, actually one of the best performing, up 187%. Over the last 10 years, actually the best performing, up 1,382. But remember, past performance is not an indicator of the future. Now, we also just want to flag that the S&P has outperformed in the last 12 months, but when we look at both over the last 5 years and over the last 10 years, Evolution has significantly outperformed. Remember, we are just flagging this because ultimately we should consider whether or not we should invest a portion or some of our money into a low-cost ETF that does track the S&P. Now, our intrinsic value comes to $120. We're going to run very quickly into each one of these models. Now, the first one is Graham's valuation, where we have the ticker symbol, the EPS, the long-term growth rate, AAA corporate bond yield, to give us our first intrinsic value showing undervaluation. But remember, we're not looking at any one of these models in pure isolation. We then have the multiples valuation, companies in a similar sector that we identified earlier, giving us our second undervaluation signal. We then move on to the dividend discount model, very rapid increases as we saw. Being a lot more conservative, we get our third undervaluation, and then we get our discounted cash flow, free cash flow year on year, average growth 58. We've been a lot more conservative at 5. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and again, 4 for 4. So average $120. Remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Evolution or any others. But as we said, MOS 10%. If we use that, it is because we believe it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Then it's a buy up to $108. We keep going till it's near the current trading price, and what we can see in today's episode, you are getting a 40% MOS at around $72, with Wall Street themselves a price target of $121, upside of 66%. Question is 40% the MOS sufficient for you? We did run through some of the risks. We had regulatory risk, market concentration, competition, currency, economic risk, reputation, as well as technological dependence. As we can see though, 40% MOS, 66% upside. Is this one you are looking to buy? Maybe one you already have, or perhaps you are looking just to sell. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do talk about our weekly buys and sells. And as always, we'll see you on the next one and have a great day.